What if I told you that a bunch of 12-year-olds, yes, 7th graders, built a stock portfolio that bet almost every professional investors on Wall Street? Not in a game, not in a dream, in real numbers. A 70% return. The story and the powerful lessons behind it come straight from Beating the Street by Peter Lynch, one of the most successful investors of all the time. And in this video series, we are going to walk through his book chapter by chapter and break down the ideas in the simplest way possible. Now let's start with the introduction part of the book. Lynch starts off by saying something bold. He's like, listen, if you really want your money to grow, stop playing it too safe with bonds and FDs. You have to invest in stocks. And he's not just guessing here, he's got the numbers to prove it. He shows how even during one of the best periods of the stock market, most people were doing the opposite of what they should. Instead of putting more money into stocks, they were pulling out and running towards bonds, cash deposits, and other low return options. In fact, between the 1960s and 1990, the percentage of household money in stocks dropped from 40% to just 17%. This was while the stock market was booming. Imagine skipping the party when it's just getting started. Peter Lynch compares what would happen if you had invested $100,000 in bonds versus stocks over a 64-year period. Bonds would have grown your money to about $1.6 million. Not bad, right? But if that same money went into the S&P 500, you would be sitting on $25.5 million. Big difference, right? And to make it a bit fun, he throws in what he calls Peter's principle. Gentlemen who prefer bonds don't know what they're missing. Then he shares a really cool calculation. He says, let's say you invested $1,000 in the market in 1940, and every January after that, you added another $1,000. Over 52 years, that $52,000 total would have become $3.5 million. But here's the exciting part. If you were even braver and added $1,000 extra every time the market dropped by 10%, that investment could have become $6.2 million just by regular and a little bit bold when everyone was scared. So yeah, Lynch is very clear from the start. Don't run away from stocks. You don't have to time the market perfectly. Just stay invested and stay consistent. Alright, now let's get to the best part. Chapter 1. This story is just too good. There's this school called St. Agnes in Massachusetts, and a group of 7th grade kids did a stock picking project. Each team got to build a pretend portfolio with $250,000, and they had to pick the companies and explain why. They weren't using any fancy financial tools or deep analysis. They just picked companies they understood and liked, brands they used in real life. So their top picks: Disney, Nike, Pepsi, The Gap, Topps because they love trading baseball cards, even a pen company called Pentech that made those cool markers kids loved. And their results, a 70% return in just 2 years. That's more than double what the overall market did in the same time. Lynch was so impressed that he invited them to lunch at Fidelity, and for the first time ever, they served pizza in the executive dining room. So, what was the magic behind their stock picking? Their teacher, Miss Morise, had a simple rule. If you can't explain what the company does, you're not allowed to invest in it. That's where Lynch gives us another gem. Never invest in any idea you can't illustrate with a crayon. If you don't understand what a business does, how will you know if it's doing well or not? And these kids didn't just randomly guess. They read business newspapers, learn how to check earnings, look for companies with low debt, and thought about whether the products were actually popular with people. They even spotted Pentech as a good investment just because they liked their pens, and that stock almost doubled. Lynch admits he got a tip from the 7th grader and still missed out. But here's the part that really stayed with me. After the whole experience, the students made a recording, a little chorus of investment lessons they had learned. And honestly, these are so powerful and so simple that I feel like we should all stick them on a wall and read them once a day. Here's what they said. A good company usually increases its dividend every year. You can lose money in a very short time, but it takes a long time to make money. The stock market really isn't a gamble as long as you pick good companies that you think will do well, not just based on the price. You can make a lot of money from the stock market, but can also lose money, as we proved. You have to research the company before you put your money into it. You should always diversify. Out of every 5 stocks you pick, 1 will be great, 1 will be bad, and 3 will be okay. Never fall in love with a stock. Keep an open mind. You should do your homework before buying anything. Utility stocks give higher dividends, but growth stocks can make you more money. Just because a stock has gone down doesn't mean it can't go lower. In the long run, small companies can give better returns. Don't buy a stock just because it's cheap. Buy it because you understand it. It literally sounds like an advice from seasoned investors. These are just 7th graders. And guess what? It wasn't just these kids. Lynch also talks about adult investment clubs, groups of regular people who meet monthly, discuss stocks, and invest together. Most of these clubs actually beat the market too. And their secret? They follow a system. They invest regularly, they don't panic, and they stick to simple principles. Only hold as many stocks as you can keep track of. Invest regularly, don't try to time the market. Look for companies whose sales and earnings are growing. Check if the company is strong enough to survive tough times. Buy only if the company's growth fits your goals and the price is fair. Try to understand why the company grew before. Can that growth continue? Simple stuff, but super effective. So, what did we really learn from the first chapter? Investing isn't some secret skill only for rich people or experts in suits. If school kids can beat the market using common sense, so can we. And most importantly, investing is about being curious, consistent, and calm. Understand what you're putting your money into and stick with it, even when the headlines look scary. In the next video, we'll move on to chapter 2, The Weekend Warrior. It's all about how fear and news can mess up your decisions and how to stay focused when everyone else is panicking. So don't forget to like, subscribe, and hit that bell icon so you don't miss it. Until then, stay curious, think long term, and maybe even borrow a crayon next time you're thinking of investing.